All right, let's dive into an energy company that, according to our source material, might just be a giant hiding in plain sight. We're talking about Energy Transfer. So, what's the story here? And why does the market seem to be getting it so wrong? Let's break it all down. I mean, you can't get much more direct than this. This quote really gets right to the heart of the matter. It's a bold claim, for sure, and it sets up this classic battle, conventional wisdom on one side and a much sharper contrarian take on the other.
So first up, we've got to tackle the market's misunderstanding. We're going to unpack what our source calls the lazy take and compare it to the much sharper argument that this company is an absolute powerhouse in disguise. And that really is the question, isn't it? If you just glance at the numbers, you might think, okay, high yield, probably a slow, kind of boring income stock. But is that really the whole story here? Let's start by digging into some of the myths.
Okay, let's tackle the biggest myth head on. The idea that this company is just a yield pig. You know, a business whose best days are long gone, and it's just paying out a big, risky dividend to keep people interested. So right here, you see this massive clash between perception and reality. The myth says the business is stagnant, that it's just treading water. But the data? It tells a completely different story. We're talking record or near record volumes of gas, crude, and natural gas liquids moving through their system. It's kind of hard to call a business stagnant when it's that busy.
And what about that juicy yield? Well, the common fear is that a high yield automatically means high risk. But the analysis points out that the company's cash flow covers its payout about 1.7 times over. So the big takeaway here is it's not just covered, it's comfortably cushioned. And that gives them a ton of breathing room to fund growth and manage their finances. Okay, so if we toss those myths out the window, what's the real story? Well, it all starts with an incredibly strong foundation. Our source actually calls Energy Transfer a scale monster. And when you see the numbers, you'll get why.
Get this, the company is guiding to at least $16.1 billion in adjusted EBITDA for 2025. Just think of that number as a proxy for its raw earnings power. That is an absolutely massive figure that just doesn't fit with the idea of a business that's, just muddling along.
Now let's talk about the debt, because that's one of the biggest criticisms you'll hear. But the analysis argues you have to see this in context. Yes, the leverage might seem high compared to some other companies, but it's operating right inside the lines they drew for themselves. According to the author, this isn't reckless, it's just their policy. So why would they be comfortable with that level of debt? Well, this slide explains the whole concept of the flywheel effect. The argument is that Energy Transfer is strategically using its financial muscle to fund these high-return projects, which then generate even more earnings. So in this view, debt isn't just a burden, it's the fuel that keeps the growth engine turning. And all of that transforms the story. This isn't just a static income stock anymore. It's more like a compounding machine. The company isn't just trying to maintain its payout, its stated goal is to actually grow that distribution by 3 to 5% every single year. Okay, so beyond that solid core business, there's this other major piece of the puzzle, a piece that the market seems to be treating like it's worth almost nothing, and that's the Lake Charles LNG export project. Our author calls this the sizzle. And look, this project isn't just some fantasy on a PowerPoint slide anymore. In 2025, it started hitting some very real, very tangible milestones. You've got a key deadline extension from the government. You have a major partner coming on board to help share the cost. And you have customers, actual customers, signing long-term deals to buy the product. In other words, this thing is getting real fast. And here is the absolute kicker from the source. Despite all this progress, the market still treats this project like it's vaporware, like it's not even real. And what that means is any potential upside from this massive project is essentially a free call option for investors at today's price. You're just not paying for it. So, at the end of the day, what is the market missing? Let's put the common perception and the sharper reality right next to each other. On every single key point, there's this huge gap. The market sees a simple utility. The analysis sees a scale monster. The market sees a risky dividend. The analysis sees a compounding machine. And the market sees a speculative mirage, while the analysis sees a de-risked opportunity that you basically get for free. So let's wrap this all up. What's the bottom line? Well, the business is growing, not stagnating. That high yield you see is well supported by a river of cash flow. The leverage they have is strategic, not reckless. And that LNG project, it represents a massive, underpriced upside. It all points to one conclusion. This just might be a durable, cash compounding machine that the market is simply getting wrong.
Which really leaves us with this final thought. If this analysis is right and the market is wrong, the ultimate question isn't if the market will catch on, but when. And that disconnect, right there, is the entire opportunity.